Hello, everyone. Happy Monday. Happy October and the start of Q4 2022. Let's take a look at jobs. Let's take a look at inflation, look at some technical indicators that we're looking at, as well as a few model updates from some of our research partners. We'll also take a look at where the market might be headed in the short term, plus some long-term bear market reminders. Let's get into it. This first chart is of the 10-year, of the dollar. I started with the dollar. So the dollar index is down to 111 after reaching a peak of just shy of 115. As a reminder, the dollar is an indicator of the strength of our economy. So strength of our economy would be good. I think right now it's just the less of all the evils, right? Slowing growth across the globe. The dollar is what people borrow money in, do transactions with the US, and in order to pay back debt that they owe to other people or other countries, most of these transactions happen in dollars. So this is a chart of people chasing dollars, having to buy dollars in order to conduct the business they need to conduct. That strength causes strain on the global economy because they have to convert more of their own currency into dollars and can weaken that economic country. So we'll continue to pay attention to the dollar, but seeing some easing in the dollar is a good sign for global economics. Looking at the 10-year Treasury yield here, after reaching 4, we're back down to 3.6%. Again, that strength is underneath the surface because the Fed has been raising interest rates. Now, we know the Fed's probably going to continue to raise into year end. That does not mean this has to go a lot higher. The market is always forward looking, so it is already pricing in those interest rate hikes by the Fed going into the end of 2022. This weakening of the 10-year Treasury here in the last couple of days is more of a sign of people probably looking into mid-2023, trying to see where the economy is going to be then. So inflation, obviously that's been driving a lot of the conversation here lately. There's tons of things I could show and that we're getting from our research partners about inflation falling. This one from Fundstrat shows how there is typically a peak in home price changes year over year before the peak in core inflation. So you can see in 2000, 2006, 2014, inflation and home prices were increasing. Okay, home prices peak and roll over before inflation. And if you zoom in up there on the top right, you will see home price change has peaked, it's fallen, but yet we've not seen that fall of inflation yet. But if history repeats itself, that could be on the near-term horizon. This is a look at job openings. So it's been a lot of publication over the last year on how the job openings to everyone looking for a job was at 2.0. So 2 job openings for every 1 person looking. That number has historically been somewhere between 1 and 1.2 when things settle out in normal market environments. And we'd like to see that number start to fall back down. This shows on the left-hand side, Indeed, which is online, being able to post jobs online. You can see 2021 off like a rocket up and to the right. 2022 starting to see those numbers come back down. On the right-hand side, Conference Board's HWAL index, Help Wanted Online. Okay, you can see 2021 rising, 2022 starting to fall. This next one is showing the correlation to the Help Wanted Online Index to U.S. job openings that gets reported shortly after. So the Help Wanted Online Index for August was minus 0.8. You can see how closely related in the gray bars and the blue bars to Help Wanted Online Index, how closely related it is to JOLTS when that number is reported. So expecting JOLTS to come down August 22, the research showed that that would take the job openings to people looking to 1.85, off the boil a little bit from the 2.0 numbers we've been seeing. Both of these things could be a good indicator that as job openings start to slow, the amount of people working, possibly an increase in unemployment. But what all that's going to mean, hopefully, is a decrease in inflation. Let's look at a few technicals, a few charts here. This is of the S&P 500 first. You can see that after getting resistance from the 200-day moving average, that red circle there, the market has rolled over down to its June lows. We did actually fall below the June lows on Friday. Pretty good rally day today. Hopefully Friday was an oopsie day and we stay above that purple line and the June lows and start to see a recovery from here. Taking a little bit of a longer term look, obviously we're long-term investors here. This is the S&P 500 still, but a weekly look. Every one of these candles or these bars that you see represents 1 week's worth of trading. Now, obviously same chart, right? But if you look at the bottom right, what I want to show here in that green line is we're starting to see some divergence in relative strength. Relative strength is a momentum indicator that we see starting to build here. Now, the market's hitting lows, but this divergence is often seen when the market has a potential to turn around. Doesn't mean it's going to, but this is commonly something we see. This is a look at the NASDAQ, okay? This growthier, more tech side of the market that's been carrying us here for the last, let's just call it 15 years. Back down here to the June lows again. Good rally today. We have hit oversold numbers at 30 on the relative strength. Looking again at a longer term perspective, though, you can see still getting that divergence in relative strength. So hopefully this is a sign that the markets are starting to find some footing and we can turn around. Doesn't mean we're going back to the top, but hopefully some short-term relief. And one of our research partners' models shows that here. We'll talk about that by the end. This is from Thrasher Analytics, a data and analytical research firm we've partnered with. You can see on the top, there's a lot going on in this chart, but on the top of the chart, you can see the S&P 500 again hitting these June lows. However, this time, the number of stocks making new 52-week lows, 6-month lows, 3-month lows, and 20-day lows is less. Okay, so broader market hit new lows, but the average stock is not. Okay, again, this is a sign of divergence. Okay, not that it can't happen, but right now we're seeing more strength in the underlying securities. Hopefully, the market will be able to follow suit next. This is a look at Thrasher Analytics Maestro model. This has a lot of different things built into the model, things like trend and sentiment, economic indicators, volatility, a lot of things combined into one number. What I want to show here was, it's kind of hard to see in the top right here, we got a blue line. My camera is blocking it. You can see in the bottom left here that those blue arrows represent aggressive bullish signal. Okay, so you can see in the last couple of instances over the last few years, when you've gotten one of these blue aggressive bullish signals, the market has shown some strength over the preceding weeks. Now, if you look at the bottom mark, it has a capitulation gauge, which means, okay, is the market exhausted? Okay, we have not reached the number of 6 that it's looking for. If you look on the left-hand side, when you get that 6 on the capitulation gauge, it's a much more indicator of, okay, the market's exhausted from going in the direction it was going, time for a reversal. In June, on those June lows we've been talking a lot about, you can see we got the aggressive bullish signal and the market did recover, but we never got that 6 on the capitulation gauge. And therefore, it was more of a short-term bear market rally versus the beginning of a new bull market. So we are looking in the short term for some possible bear market rally here over the coming weeks. This is just an important chart to send, the healthy reminder, if you will, of what's going on in bear markets and how we need to, kind of work our way through it. You will see on the bottom is every bear market 56 to 2020. On the bottom is the total drawdown, ranging anywhere from 21% to 57%. That was what the bear market was. And then on the top in the green, you will see the preceding bull market after that bear market. So you can see if you can get through these tough moments in time, there are healthy rewards for staying invested, investing more, or even getting more aggressive in these moments. Another gentle reminder, I really liked this one. This is showing after a 20%. If you look at the middle column, okay, the blue, gray, green in the middle, let's just look at that one. After a 20% market decline, okay, the 1 year average return after that is 22%. The average 3-year return is 41%, and the average 5-year return is 71%. So we're down about 25%, a little bit less right now. So we would be in this bucket right here, that if we can get through this, if you can stay disciplined and think long term, there are healthy rewards that follow. And we are super focused, talking every day, really engaging with our research partners and reading all the information they can provide to us to be prepared for the market return, okay, the bull market return, if you will. So there's still potentially some downside along the way. We'll do what we can to protect the downside, but we have to start shifting our focus just a little bit, that it might be time to get really focused on the recovery and less about protecting to the downside. You know, we rarely get markets that fall greater than 25%. They happen, but it's few and far between. So when you start to get over that 25% drawdown, it's time to start thinking long term and, hey, how do I take advantage of this versus that focused mindset of how do I protect from losses. So as always, call us with any questions. Appreciate your time. We'll be sending a lot of videos over the coming weeks, and we'd love to get any feedback we can of anything you'd love to hear about from us. So hope you have a great rest of your week, and we'll talk to you all very soon.